Welcome. In this video, we'll explore the world of exchange-traded currency options. Whether you're new to finance or looking to deepen your understanding, this chapter will guide you through the essentials. We'll start by clarifying what options are, how they differ from other derivatives like futures, and why they're such a powerful tool for managing risk and seeking profit. By the end, you'll have a solid grasp of key concepts, pricing, payoffs, and contract specification. Let's begin our journey into the fascinating landscape of currency options. Options are unique financial contracts that grant the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specified period. Unlike futures, where both parties are obligated, options provide flexibility. The buyer pays a premium for this right, while the seller receives the premium and assumes the obligation. This structure allows buyers to limit potential losses while still participating in potential gains. Options are widely used in currency markets to hedge risks or speculate on price movements. Make options more relatable, let's consider a real-life example. Imagine Mr. X wants to buy a piece of land from Mr. Y for Rs 1 million. Mr. X pays a non-refundable fee of Rs 50,000 for the right to buy the land in 3 months. If the land's value rises, Mr. X can buy at the agreed price and profit. If not, he can walk away, losing only the fee. This arrangement mirrors an option contract where the fee is the premium and the right to buy is a call option. Let's break down the key terms from our example. The right to buy is called a call option, while the right to sell is a put option. The agreed price is the strike price. The date when the option expires is the expiration date, and the period between contract and expiry is the time to maturity. The buyer pays a premium and the seller receives it. The underlying asset is what's being bought or sold. Exercising the option means using your right to buy or sell at the strike price. Call option gives the buyer the right to purchase the underlying asset at the strike price, while a put option gives the right to sell. In our land example, Mr. X holds a call option. In another scenario, buying car insurance is like buying a put option. You pay a premium for the right to claim compensation if your car is damaged. If nothing happens, the insurer keeps the premium. These examples show how options work in both financial and everyday contexts. Both futures and options are derivative contracts with buyers and sellers, set prices and settlement dates. However, futures obligate both parties, exposing them to unlimited risk and reward. Options, on the other hand, only obligate the seller. The buyer risks only the premium paid, while the seller faces potentially unlimited losses. This key difference makes options attractive for those wanting to limit downside risk while retaining upside potential. Options come in two main styles: European and American. European options can only be exercised on the expiration date, offering less flexibility but are common in currency markets. American options can be exercised at any time up to expiry, providing more flexibility. On exchanges, you can also sell your option in the secondary market before expiry, regardless of style. Generally, American options are priced higher due to their added flexibility. Linus describes whether exercising an option will result in a profit, loss, or break-even. An option is in the money, ITM, if it yields a positive cash flow when exercised. A call is ITM if the spot price is above the strike price. Put is ITM if the spot price is below the strike price. Out of the money, OTM means exercising would result in a loss. At the money, ATM means the spot price equals the strike price, resulting in zero cash flow. Price of an option, known as the premium, consists of two parts: intrinsic value and time value. Intrinsic value is the amount by which an option is in the money. Only ITM options have intrinsic value. ATM and OTM options have zero intrinsic value. Time value is the extra amount buyers are willing to pay for the possibility that the option will become profitable before expiry. The longer the time to expiry, the higher the time value. Option prices are influenced by several key factors: the spot price of the underlying asset, the strike price, time to expiration, volatility, and interest rates. For example, a higher spot price increases call option value but decreases put value. Greater volatility raises premiums for both calls and puts, as there's a higher chance the option will become profitable. Longer time to expiry also increases premiums, while interest rates have varying effects depending on the option type. Option Greeks are measures that help traders understand how various factors affect option prices. The 5 main Greeks are delta, gamma, theta, vega, and rho. Each Greek represents a different type of risk or sensitivity. Delta measures price sensitivity, gamma measures the rate of change of delta, theta measures time decay, vega measures sensitivity to volatility, and rho measures sensitivity to interest rates. Mastering the Greeks is essential for effective option trading. Delta measures how much an option's price will change for a small change in the price of the underlying asset. For a call option, delta is positive and ranges from 0 to 1. For a put, it's negative, ranging from 0 to -1. For example, if a call option has a delta of 0.3, a 1-point increase in the underlying asset's price will increase the option's premium by 0.3. Understanding delta helps traders anticipate how their option positions will react to market moves. See delta in practice. Suppose the USD INR is at Rs 82.8 and you hold a call option with a delta of 0.55. If the underlying price rises by 0.2, the option premium increases by 0.11, 0.2x, 0.55. If the price falls by 0.2, the premium decreases by 0.11. This calculation assumes other factors remain constant. Delta helps you estimate potential gains or losses as the market moves. Gamma measures the rate of change of delta as the underlying asset's price changes. Think of gamma as the acceleration of delta. A high gamma means delta will change quickly as the market moves, making the option more sensitive to price swings. For example, if a put option has a delta of -0.5 and gamma of 0.004, a 10-point move in the underlying will change delta by 0.04. Gamma is crucial for managing risk, especially for large or volatile positions. It measures how much an option's price will decrease as time passes, assuming all other factors remain constant. This is known as time decay. For option buyers, theta is usually negative, meaning the option loses value each day. For sellers, theta is positive. For example, if theta is minus 0.05, the option premium will drop by 0.05 each day. Time decay accelerates as expiration approaches, making it a key consideration for traders. IGA measures how much an option's price will change with a 1% change in the underlying asset's volatility. Higher volatility increases the chance of the option becoming profitable, so Vega is positive for both calls and puts. For example, if Vega is 0.15, a 1% increase in volatility will raise the option's price by 0.15. Vega is especially important when markets are uncertain or expected to become more volatile. O measures how much an option's price will change with a 1% change in the risk-free interest rate. For call options, rho is positive, higher rates increase call prices. For puts, rho is negative, higher rates decrease put prices. For example, if a put option has a rho of minus 0.05, a 1% drop in interest rates will increase its price by 0.05. Rho is more significant for longer-dated options and in changing interest rate environment. Call parity is a fundamental relationship between European call and put options with the same strike price and expiration. It states that the price of a call plus the present value of the strike price equals the price of a put plus the spot price of the underlying asset. This relationship ensures there are no arbitrage opportunities in the market. Understanding put-call parity helps traders spot mispricings and construct synthetic positions. To determine the fair value of an option, traders use mathematical models. The two most popular are the binomial pricing model and the Black-Scholes model. The binomial model simulates possible price paths in a step-by-step manner, making it flexible but computationally intensive. The Black-Scholes model, on the other hand, provides a quick formula for pricing European options, assuming no dividends and random market movements. Both models are widely used in currency market. Developed by William Sharpe, the binomial model represents the possible future prices of an asset as a tree of up and down movements. At each step, the price can move up or down by a fixed amount. The model calculates the value of the option at each node, working backward from expiration to the present. It's highly accurate and can handle both European and American options, but it requires more computation than simpler models. Black-Scholes model, introduced in 1973, is a fast and widely used method for pricing European options. It calculates the theoretical price using factors like the current asset price, strike price, time to expiry volatility, and risk-free interest rate. The model assumes no dividends and random price movements. While it has limitations, such as not accounting for early exercise or dividends, it remains the standard for pricing exchange-traded currency options. Dividends can affect option prices, especially for stocks. In the Black-Scholes model, short-term options adjust by subtracting the present value of expected dividends from the asset price. For long-term options, the model can be modified to include a constant dividend yield. In currency options, dividends are less relevant, but understanding these adjustments is important for accurate pricing in other markets. Black model is a variation of Black-Scholes, designed for pricing options on futures contracts. Instead of using the spot price, it uses the discounted value of the future price. This model is especially useful for valuing options on interest rate products and commodities. Indian exchanges use the Black model for pricing exchange-traded interest rate options, where the underlying is a government security or a futures contract. Applied volatility, or IV, is the market's forecast of the likely movement in an asset's price over the life of an option. Unlike historical volatility, which looks at past price changes, IV is derived from current option prices using models like Black-Scholes. IV reflects the consensus of market participants and is a key input for option pricing. High IV means the market expects large price swings, while low IV suggests stability. Applied volatility directly impacts option premiums. When IV rises, option prices increase, benefiting option holders. When IV falls, option prices decrease, favoring option sellers. IV does not indicate the direction of price movement, only the expected magnitude. In bearish markets, IV tends to rise as uncertainty increases. In bullish markets, IV usually falls. Traders monitor IV closely to time their options strategies effectively. Payoff diagrams visually represent the potential profit or loss from an option position at expiration. For a long option position, the maximum loss is limited to the premium paid, while the profit potential depends on how far the underlying price moves in your favor. For a short option position, the maximum gain is the premium received, but losses can be unlimited. Understanding payoff diagrams is crucial for managing risk and planning strategy. Let's look at a long call example. Suppose you buy a call option on USDNR with a strike price of 83, paying a premium of 0.1. If the spot price at expiry is below 83, you let the option expire and lose only the premium. If the spot price rises above 83, you exercise the option, buying at 83 and selling at the higher market price. Your profit is the difference minus the premium. The break-even point is the strike price plus the premium. For every buyer, there's a seller. If you sell a call option, your maximum gain is the premium received. If the underlying price stays below the strike, you keep the premium. If the price rises above the strike, your losses can be unlimited, as you may have to deliver the asset at a lower price. The break-even point is the strike price plus the premium. The short call payoff is the mirror image of the long call. Long put option gives you the right to sell the underlying at the strike price. If the market price falls below the strike, you exercise the option and profit from the difference minus the premium paid. If the price stays above the strike, you let the option expire, losing only the premium. The break-even point is the strike price minus the premium. Long puts are used to profit from or hedge against falling prices. Selling a put option means you receive a premium and are obligated to buy the underlying if the price falls below the strike. Your maximum gain is the premium received. If the price drops sharply, your losses can be significant, as you must buy at the strike price even if the market price is much lower. The break-even point is the strike price minus the premium. The short put payoff is the mirror image of the long put. Options have asymmetric risk profiles. For buyers, the maximum loss is limited to the premium, but profits can be unlimited calls or substantial puts. For sellers, the maximum gain is the premium, but losses can be unlimited or very large. This asymmetry is a key reason why options are popular for hedging and speculative strategies, offering controlled risk for buyers and potential income for sellers. Just like futures, option positions can be closed before expiry by taking an opposite position in the market. For example, if you bought a put option and later sell the same contract, you lock in your profit or loss. The difference between the premium paid and received determines your net gain or loss. Squaring off provides flexibility and allows traders to react to changing market conditions without waiting for expiry. Exchange-traded currency options are standardized contracts listed on regulated exchanges. In India, these include options on USD-INR, EUR-INR, GBP-INR, and JPY-INR, as well as cross-currency pairs like EUR-USD. These contracts have fixed lot sizes, strike price intervals, and expiry dates. Trading is transparent, with prices discovered through market interaction. Settlement is usually in cash, based on reference rates published by authorized agencies. INR-based currency options, each contract represents 1,000 units of the underlying currency, USD, EUR, GBP, or 100,000 units for JPY. Premiums are quoted in INR and the minimum tick size is 0.0025. Trading hours run from 9:00 a.m. to 5:00 p.m. Contracts are available in monthly and quarterly cycles, with multiple strike prices provided for each expiry. Settlement is cash-based, using official reference rates. Cross-currency options, such as EUR-USD or GBP-USD, are also traded on exchanges. Each contract typically represents 1,000 units of the base currency. Premiums are quoted in the quote currency USD or JPY. Trading hours extend to 7:30 p.m. and contracts follow similar monthly and quarterly cycles. Settlement is in INR, calculated using reference rates for both currencies involved. These contracts provide more choices for hedging and speculation. Exchange-traded currency options are available for trading Monday to Friday, typically from 9:00 a.m. to 5:00 p.m. for INR pairs and up to 7:30 p.m. for cross-currency contracts. Weekly contracts expire on Fridays, while monthly contracts expire 2 working days before the last business day of the month. On expiry days, trading in the expired contract is allowed until 12:30 p.m. This structure ensures regular opportunities for traders to enter and exit positions. Settlement for exchange-traded currency options is typically cash-based. The final settlement price is determined using reference rates published by authorized agencies, such as the FBIL in India. Settlement is usually completed on a T+2 basis, meaning 2 business days after expiry. This system ensures transparency and reduces counterparty risk, making exchange-traded options a reliable tool for hedging and trading. Exchange-traded currency options offer several advantages over over-the-counter OTC options. They are standardized, ensuring transparency and ease of trading. The centralized platform eliminates counterparty risk, as settlement is guaranteed by the clearing corporation. Liquidity is higher and prices are discovered through open market interaction. These features make exchange-traded options accessible and attractive to a wide range of market participants. Despite their benefits, exchange-traded options have some limitations. Contracts are standardized, which may not suit every hedging need. Settlement is in cash, so users seeking physical delivery must access the spot market separately. There are also operational requirements such as margin maintenance. While liquidity is generally high, it may be lower for less popular contracts or during off-peak hours. OTC currency options are customized contracts negotiated directly between parties, often banks and clients. They offer flexibility in terms, size, and expiry but come with higher counterparty risk and lower liquidity. Price discovery is less transparent and settlement is usually bilateral. In contrast, exchange-traded options are standardized, liquid, and settled through a clearing corporation, reducing risk and increasing transparency. In deciding between exchange-traded and OTC options, consider your needs. If you require a highly customized contract, OTC may be suitable, but be aware of the risks. For most traders and hedgers, exchange-traded options offer a balance of flexibility, transparency, and safety. Assess your objectives, risk tolerance, and market access before choosing the best instrument for your strategy. Suppose you're an exporter expecting USD payments. You buy a USD-INR put option to hedge against a fall in the dollar's value. If the rupee strengthens, your option gains value, offsetting your loss in the spot market. If the rupee weakens, you let the option expire, losing only the premium. This strategy provides protection while allowing you to benefit from favorable moves. Options aren't just for hedging, they're also used for speculation. For example, if you expect the USD-INR to rise, you might buy a call option. If the market moves as expected, your profits can be substantial while your loss is limited to the premium. Speculators use options to leverage their market views with controlled risk, making them a popular tool for active traders. We've covered the essentials of exchange-traded currency options: what they are, how they work, key terms, pricing models, payoff diagrams, and contract specifications. We also compared exchange-traded and OTC options, highlighting their respective advantages and limitations. Understanding these concepts will help you navigate the currency options market with confidence, whether you're hedging, speculating, or just exploring. Congratulations on completing this comprehensive overview of exchange-traded currency options. You now have a strong foundation to build on, whether you plan to trade, hedge, or simply understand the mechanics of these versatile instruments. Continue exploring advanced strategies, practice with real or simulated trades, and stay updated on market developments. The world of currency options offers endless opportunities for learning and growth.